All right, welcome in everybody. I see people are starting to join. We have a great presentation for you today. I'm excited for this one. Going to give everybody a few minutes to actually properly connect to the webinar to Zoom, and then we'll kick things off shortly. I hope everybody's having a great start to their day, and I appreciate your patience.
Great to be here with you guys. How's everybody doing today? Definitely use the chat. I'd be happy to answer questions as we go. If you guys throw some hellos and other greetings in the chat, we'll definitely keep that up on the screen here.
Oh, I actually forgot to bring up my intro slide, so perfect timing. All right, just another few seconds while I can see people are still funneling in, so very shortly we'll kick things off. And like Robert said, use the chat Q&A functions. I opened it up, so you should have access to that. And don't be shy.
Welcome, Bill. Nice to have you. Thanks for the comment. Yeah, I recognize a couple of names in the chat.
Yeah, welcome. Thanks everybody for joining. All right, I think that should be enough time, and let's kick things off. Hello, everyone. My name is William Mucker. I'm a client executive with Camaplan and would like to thank you all for joining us for today's webinar, Earning Real Estate Income Without Tenants, Toilets, Taxes, and Trash with Robert Hytha. As a quick note, please be aware that we'll be answering questions at the end of the presentation. However, feel free to use the chat and/or Q&A function on your screen to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. As always, before we get started, we have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of that dialogue with your team of professionals to make sure that the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into the investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me. I'll be more than happy to help. And without further ado, I'll pass the controls over to you, Robert.
Hey, thanks, guys, and I appreciate it. Well, I'm happy to be here with you. It's my first webinar in quite a while, so I'm looking forward to sharing with you what I've been really working on for the last, since 2011, like almost, 14 years now. So this presentation is going to be earning real estate income without tenants, toilets, and trash. I left off the taxes because you do have to deal with taxes as a note investor, but not how you would in traditional real estate, which we'll get into soon here. So I believe this is the easiest way to earn passive income, and that is real estate note investing. And it's especially powerful in a self-directed IRA. I own performing notes in my IRA. So that's why I'm actually going to be leaning towards cash flowing paper, cash flowing mortgage notes in this presentation, although I really am a specialist on the non-performing side. So we'll definitely talk about non-performing notes a little bit. Higher returns there, but not as good of an investment for a self-directed IRA because they do need to be actively managed. But let's hop right into it here. So first of all, who am I? My name is Robert Hytha, and I would be what you'd refer to as a recovering landlord. So I bought my first place in, I think it was 2013, so about a decade ago. It's the property on the right of this connected twin. And it was awesome. I mean, I was very excited going in and had the assistance of my father, who's been a real estate investor for a long time. So that gave me a lot of confidence buying my first rental property. I was actually still living in my parents' house when I bought this place. So I was really happy for that cash flow coming in. And as fate may have it, the month after I purchased this side of the building, I got a call from the landlord over here on the other side. I don't know if you can see my mouse, but the left side of the building is a connected twin here. They called me up. They were an absentee landlord out of state, and I was able to negotiate a lease option with them to take over this property as well. But day one of that lease option, the plumbing stack breaks and there's sewage backing up into the sink. And I had to scramble to figure out how to replace an old cast iron stack going out to the sewer. Luckily, I had my father's help there, but not a pleasant way to start your second investment property. Later, though, I bought another building. Didn't deter me yet. And this is a quadplex. First floor is a laundromat, and then there's a efficiency unit on the back here and a detached garage. And then above, there's a second floor unit and a third floor unit. And it was pretty exciting. I mean, I didn't really know what to do. So here I am standing here with the keys to this place with the beat up floor and some old machines, and just had to figure it out as I went along, which is exciting. But as you'll see here as we go, you can definitely get to a point in your real estate career where you're tired of the trash and the toilets and the termites. I actually have a picture of some trash coming up. So it's brutal. And the apartments upstairs, rough shape. We had to expose the plaster to get to the plumbing below the sink in the bathroom of the third floor. The corner unit, the second floor, was just deteriorating plaster. So we did a bunch of work, got brand new machines in the laundromat. We worked on reframing those walls, and we were feeling good. Everything's fixed. Time for passive income. Finally, these rental properties are looking good. But I'm totally kidding, because it's endless when you own a rental property. Piles of keys, trash in the laundromat is just endless. It's just a nightmare. And while it does produce some good income, not as much when you have a property manager, because you do have to split a lot of that income with, the manager working on site. It's still pretty difficult, even with the property manager. So finally, found a better way, and that is the paper business. And this particularly resonated with me because, as I mentioned, my father has been in real estate for a long time, and he was such a great resource for me because he's a handy guy. He knows how to fix stuff. He can do a little bit of plumbing and electric and general contracting, but I'm better here on Zoom or on the phone or, on my computer. And I found that the mortgage note business just was much better suited to not only my skill set on the computer, but also the lifestyle that I wanted to live. I traveled with my family. We spent 2 months in Italy and France with our 1-year-old 2 years ago. And then we just got back from 2 weeks in Sicily. And I was able to do that while working because I do have a property manager for the rental properties that I showed you. Haven't sold them yet, but mortgage notes allow me to both be a portfolio manager for my clients as well as be an investor on my own, all remotely, which is just amazing. So that's the paper business. Your asset is literally just a folder of collateral documents. So it makes your life a lot easier when you don't have to deal with the bricks and the sticks. And all you have to do is look at a package of paper and a PDF online in your Dropbox to enforce your assets. And then, of course, to collect your monthly payments from your borrowers. So I started this journey. I learned about mortgage note investing originally from a company called US Mortgage Resolution. So I started working with them as an intern in 2011. I was their first employee outside of the two founders and learned the whole business from them from the ground up. So since 2011 now, I've analyzed, acquired, and monetized over 10,000 assets with US Mortgage Resolution. That's over $566 million of unpaid principal balance of non-performing mortgage loans. So it's really important to understand the non-performing side because when you buy cash flowing paper, you want to understand worst case scenarios. And there are a lot of different ways to invest in notes, which we'll get into in a minute here. But I appreciated coming from the non-performing side to then also buying cash flowing loans because I just had a little bit more confidence going in that if something went wrong, I knew how to handle it. And unlike those gruesome pictures of the rental property issues, the issues that you have with mortgage notes can be solved on the phone, talking to attorneys, talking to other counterparties, and using your email. Like much easier. You can do it from the comfort of your home office or wherever you have internet connection. So in that time, since 2011, we've generated over $55 million of revenue. So that's payoffs, monthly payments, and loan sales. So what's really great about this market, even when a loan is non-performing, is there's still a lot of liquidity. Now, it's not as efficient of a marketplace as the stock market, for example, but there is a thriving secondary market of buyers, investors who want to purchase non-performing and performing loans. So if you do need to cash out, you can sell these loans pretty quickly, generally less than 30 days, and there's no settlement table. You don't have to meet in person. You can do all that from your phone and your email as well, getting these loans sold and purchased. So I started FIXnotes, my current company, in 2017 to democratize the secondary mortgage market. And I still work with US Mortgage Resolution. I still operate their trade desk and do their portfolio management. But as a brand, FIXnotes, I'm able to work with other clients as well. So we've had over 2,000 investors come through our starter course, which is just an introduction to the secondary mortgage market. And we've had over 140 investors now in our professional membership. So they've got over $100 million worth of dry powder there. So there's a lot of capital to deploy. And that buyers group that we've created of professional investors lets us just swing a little bit faster, bigger fence to be able to work with big banks, institutions, and take down larger trade sizes. So having that group of investors together just rises up all of us and allows us to compete in a way that we wouldn't as individuals. So the agenda today, what I want to share with you, first an industry overview to cover some of the other ways you can invest in mortgage notes, from performing and non-performing notes, as I've mentioned, to some other more passive and more active options. Then we're going to go through kind of what I think are the 3 secrets of this business: how to find the notes, so sourcing, how to analyze, due diligence, and then how to liquidate notes, and that's your exit strategies. So then we're going to get into the Q&A, but you're certainly welcome to leave any comments you'd like in the chat as we go here. And I can't actually see the chat. I can see the Q&A. So use the Q&A if you have any questions. All right, so let's start with the industry overview. And this is where I mentioned the spectrum between passive and active. So if you want around 10% returns, sometimes less, a mortgage note fund is going to be the best option for you. And a mortgage note fund is essentially working with an operator who's going to be acquiring portfolios of loans. You'll be diversified across the entire fund, and you're working with a professional who's doing it full time. Mortgage note funds can either be active, non-performing, where they're managing distressed debt and trying to get them performing or paid off. It can also be a performing note fund, which is typically lower returns, but potentially less risky. So you can choose any number of different options, any number of different operators in mortgage note fund space. Then we have equity partnerships with private investors. So a little bit more active, a little bit more risky, but higher returns if you're going to partner directly with an operator rather than being just an investor, a participant in a big fund. As we work our way up the active scale, next would be partial acquisitions of cash flowing loans, or what we call RPLs. RPLs are reperforming loans. And the reason why generally on the secondary market we're trading reperforming and not performing loans is because a lot of these assets were once non-performing and then were brought current again to be reperforming. So with a track record, they're just as safe as a performing loan, but you're going to get better pricing and be able to have much better returns with reperformers. And as a partial investment, if you buy a partial, and you can do this in your self-directed IRA, you're able to essentially step with that investor who originally modified that loan and who owns perhaps the back half of the payments. If you know how a partial works, you could purchase the next 10 years worth of payments, and the investor who owns the deal could still own the back half of that 30-year term, 20 payments or 20 years of payments following it. Or you can buy any number of different ways partials can be split up. And as you go up the spectrum, buying your own RPLs, your own cash flowing loans, is going to give you an even higher return. Generally, for a performing loan, you're talking 14 to 20% returns in second position and slightly less in senior or first position. So a lot of this business is starts out with your intention to either pursue first liens or second liens and the type of properties that are securing those liens. So we'll get into that in a minute as well. But as we get to the final piece of this active spectrum, 40% plus returns, we're talking about buying and working out non-performing loans, which isn't as viable in a self-directed IRA, as I mentioned, because you do have to actively manage these assets for the most part, but they are definitely a way that you can fund your self-directed IRA to purchase reperforming loans. If you work with investors who buy and work out non-performing loans, acquiring those reperforming loans in self-directed IRA is a great way to collect that cash flow in a more passive sort of investment. All right, so sourcing. Let's jump right in with where to buy notes. So we're going to go over kind of the high level here, starting with research and outreach. So the first thing you can do to buy loans that are off market, that aren't on any platform or being sold by any particular loan sale advisor or broker, is by looking in the public records. The first thing you can find is assignments of mortgage that have been recorded. And an assignment of mortgage is essentially a transfer of that asset, the mortgage note, from one seller to a buyer, one lender to a new lender. And by scouring public records in the counties where you'd be interested in purchasing, you can find assignments that have been recorded to either target the assignee, so that's the person who's received the mortgage note, because now they own that note, so maybe they'd be interested in selling it, or the assignor, because you know they have transferred a note to someone, so maybe they have more notes to transfer. So that research looking at public records is one way that you can target pretty specifically geographically if you're looking in a certain area. But the beauty of mortgage notes is that you can buy nationwide and you're just working with the paper. So it's best to not limit yourself just to one county, for example. And that's where we're looking through the information in the Freedom of Information Act data set. So FOIA is the FDIC data across all of the institutions in the country. There's some services that can make this a little easier to review, like Bank Prospector from the company Distressed Pro, but you can also review the FOIA information just by Googling FOIA and the FDIC data. And you can essentially see what banks have non-performing loans. And I would recommend with this strategy to work with local lenders that you could meet in person, because if you're able to establish good rapport with a local bank, a local credit union, a local institution, and really build that relationship in person, then when they have non-performing or performing loans that they have available to sell, you're going to be top of mind. So that's another way to do some research to find people who are selling notes. And then finally, mailers. This is another strategy. If you are familiar with like wholesaling, you can buy a list of potential sellers and you can send mailers. And there are companies that provide lists of lenders, either people who have taken back seller financing. So this would be a private lender who's originated a loan when they've sold a property and carried back a junior or a senior lien. So those investors sometimes want to cash out and sell their notes. Or you could also target hedge funds or banks and send your marketing far and wide to try to find different sellers of notes. Another option is just building those relationships. And I did allude to this already with local banks and credit unions, but also going to conferences and meetups and just networking online, you can reach a lot of different potential sellers. Now, I'm normally leaning towards the non-performing side, talking about banks and credit unions and institutions, but for reperforming loans, the best sellers you're going to be finding are people in the secondary market already who maybe purchase loans in bulk from a big bank or an institution and then get those loans modified, reperforming, and then flip them to people who have self-directed IRAs. So meeting them at conferences, networking online, and going to meetups, local dig meetings, that's going to be a great way to meet other lenders who may have notes for sale, because it's a really great strategy for a non-performing note investor to buy a non-performing distressed debt, get that loan modified, and then flip it. It's the easiest fix and flip because you don't have to really fix anything other than some paperwork. And a lot of those investors want to redeploy that capital. They've got a velocity model where they're going to take those funds and buy more non-performers, repeat the process. So they're always looking for investors to take on those deals. I'm going to take a look here at a question while we're on the sourcing page. New purchases are slowing currently. How would a significant decline in the real estate market affect these notes? Additionally, how would interest rates affect their performance, scenarios for rising and falling rates? Yeah, that's a great question. We're somewhat insulated in the mortgage note space because, one, these notes have been originated years ago. Often, if we buy a junior lien, the first position mortgage has a historically low interest rate, which is sort of an aside, but creates an amazing opportunity for a subject to transaction where you could buy a non-performing junior lien, acquire the property through a deed in lieu of foreclosure, and then assume subject to the first position loan to essentially step into the shoes of the borrower who had a historically low interest rate. So the interest rate environment definitely affects the refinances of loans as well. You're going to see more of these cash flowing loans pay fully to the term as opposed to being refinanced earlier. Pre-COVID and even pre-Great Financial Crisis, the average was about 7 years until a borrower would refi or sell the property. Nowadays, that's been extended because the interest rates are higher. People are staying in their homes longer. So that does affect kind of the scenarios that you'll run when you're analyzing a loan for purchase. And as far as the real estate market declining, I agree. I saw the highest prices for non-performing mortgage notes last summer. And that coincided with, I believe, where the peak of the market for most residential real estate was as well. Around June or July last year, we saw really, really, really strong housing prices. And of course, those prices have come down since. But for the most part, we're still seeing a ton of equity in these deals. Now, there will be a point where that flips, and if property values decline to the point of negative equity, then that has a much bigger effect on pricing in this market. But because we're somewhat insulated as a note investor because of a big buffer of equity, until we get a lot closer to that break-even point, 100% combined loan to value or CLTV, we're pretty safe. Once we get below or above 100% CLTV, that's when pricing really starts to change. But there is quite a long way for the real estate market in general to go before we do see that. All right, let's go on to the last step of sourcing here, and that is platforms. So you can buy loans on platforms like PaperStack. PaperStack is mostly performing loans. Not a lot of non-performing loan investors sell on PaperStack because that's the strategy. They buy non-performing, they fix it up, and they flip it on a platform like PaperStack. Also, FIXnotes, we have our pro membership where we have a trade desk, an insider's trade desk of all the other sellers and loan sale advisors across the internet. We aggregate them all together, and we also offer exclusive opportunities to our group. So platforms and sellers like us, or many others, if you Google it, you'll find a lot of options. But we'll see soon here that part of your due diligence is your counterparty. So you really want to make sure you understand who you're doing business with just as much as you want to understand what you're buying, analyzing the actual asset. And that's where we're at now, due diligence, how to analyze and value notes. So we're going to go through three things here. The non-performing waterfall. And again, I'm talking non-performing, so I'm going to skim through it mostly, but it's really important to understand if you're buying performing loans because things can go wrong. And then we're going to go through the ABCs of due diligence. And then finally, cash on cash returns versus internal rate of return and how to calculate your investment potential. So here's the non-performing loan waterfall analysis. And at the top here, you'll see secured versus unsecured. And this is the biggest driver of price. And I want to mention this right off the bat because sometimes on PaperStack, investors who have loans for sale will put an asset on a platform to distance themselves from that asset a little bit, to give themselves somewhat of a buffer, a third party in between them and the buyer, because they may be misrepresenting something that has to do with that asset. For example, an unsecured loan is the biggest driver of price. It significantly reduces the value of that loan all the way down to like half of 1%. That's what 50 BPS means. 50 basis points is half of 1%. And I have not seen a loan that's unsecured trade for as high as 5%, but it is possible if the borrower had other assets. But essentially, if a loan comes up as unsecured, most investors will kick that out of the population that they're looking to purchase. They're not even going to go into the deal. And I have had people who, before they went through our training, they bought loans that they thought were secured. They happen to be unsecured and there was no recourse in the contract they signed. They get burned pretty bad because you don't have the ability to foreclose. That borrower no longer owns the property. So the leverage that you have is pretty much gone. Now, there is some leverage. You can still pursue the promissory note, but you don't have that interest alignment with the borrower because they don't have the asset anymore. They don't have the property that you're looking to help them pay off the loan on. They don't have anything. So that becomes a very difficult situation. But if a loan is secured, meaning the homeowner still owns the property and the lien that you're looking at purchasing is still secured to that property, then we go into the waterfall here. First, determining if it's first lien or a second lien, where there is a difference in price, with first liens being more valuable generally and second liens less valuable as a percentage of the unpaid principal balance, or the UPB. And then as we go, we want to check the collateral value, so the value of the property. And of course, this also matches when you're buying reperforming loans. You need to understand how much equity you have. And we'll get to that down here at the bottom. Bankruptcy, important to understand as well. That's all public record. And generally, you don't have to be scared of bankruptcy if a borrower has filed. You can find a lot out about them in their voluntary petition. So it actually gives you a lot more information. And in general, in my opinion, you can increase the value of a deal by reducing the uncertainty. So bankruptcy in a lot of ways reduces uncertainty because all their financials are laid out. Then we've got occupancy. So if a borrower lives in the subject property, it's owner occupied, that's a more valuable asset because you know that that borrower is part of the community. They're invested in this property more than just having an asset on their balance sheet. Then we talk in first lien about title and taxes. Title reports we generally order for senior liens because it's just a step we like to take when we're spending a little bit more money on our acquisitions. A lot of second liens, I mean, I would recommend ordering title, but if you're buying a really large portfolio of seconds, sometimes you can take a little bit of that for granted and not order title. But on seconds, you absolutely need to pull credit and understand the status of the first position loan. Again, Reperforming or non-performing, if you're buying a second lien, you need to make sure that the first mortgage is current. If it's not current, it's not the end of the world. That loan just has a lot lower of a value. And the reason being, if that first mortgage continues to be in default and delinquent, eventually the first mortgage will go to foreclosure, which could put you in a position of being an unsecured lien. Or if you've got plenty of equity, you'll get surplus funds at the sale of the property when it goes to foreclosure. And then you can get a full payoff that way, which if you've got plenty of equity because you followed the other steps here, looking at the collateral value, making sure the first status and the first balance mean you have equity above it, you can get paid that way in a sheriff sale. But generally speaking, you want to look for current senior liens because every month that that first mortgage is paid down, your equity position increases. And that's where we're looking at stratified equity between full equity, partial equity, or no equity, or even underwater equity, assigning a value to each. And I like to say there's no such thing as a bad note, just a bad price or the bad analysis that you might do. So as long as you understand what you're going into, then you can price the asset accordingly. And then for first position loans, especially looking at property taxes is critical. Again, with second liens, we take this for granted, but 95% of first mortgages escrow taxes and insurance. So if the first lien is current as a junior lien holder, we're pretty confident that the taxes are current as well. But if you're buying a non-performing first mortgage, the taxes are probably non-performing as well. But even if it's a cash flowing first mortgage, you still want to confirm that that borrower is paying the property taxes. So here's a little framework I created called the ABCs of DD, which is a little simpler version of that full waterfall analysis. And it goes through a couple steps here. First, your indicative offer, your XYZ. So you want to examine all the data that you've put together when you're doing your due diligence. Your due diligence is basically just aggregating all the information you can about a particular asset into a spreadsheet so then you can make an informed decision. So you're analyzing and examining all that data. Then you're calculating your target yield based on the risk that you perceive in that deal, based on things like the borrower not living in the subject property. Maybe it's vacant or tenant occupied. And you want to assess that situation differently than if it was owner occupied. If the senior lien is not performing, if the taxes are delinquent, all of these things contribute to increased risk. And you need to basically compensate yourself for that risk by paying less. So your yield is higher on that deal should you be awarded the trade. And then finally, zeroing in on a price that meets your goals. And that's what we'll get into on the last step of due diligence here, which is looking at your cash on cash or your internal rate of return. All right, so the main thing with the ABCs, it's your asset, your borrower, and your counterparty. So the asset is the property, the underlying real estate that secures your lien. And looking at the value, occupancy, title, and taxes. I like this little acronym VOT. I forget who I heard that for originally. Probably was Chaz Gwynn from Revolve, I think, at a conference. I'm not sure. I want to credit where credit is due here. But VOT sticks in my mind. Value, occupancy, title, and taxes is a really great framework to analyzing the asset. Of course, you need to understand the property value. We like to order BPOs when we're dealing with higher value homes, or we'll have our local realtor drive out and let us know what they think it's worth. But having boots on the ground, having someone actually get their eyes on the property before you buy, just like with physical real estate, it's great to just know what the condition of the home is in. Occupancy is the next one here. As I mentioned, owner occupied is a lot better, but just making sure it's not vacant and dilapidated is important. Looking at a street view, a Google Street View, and just checking the date that that street view is captured is a great way to see if the lawn is being mowed. And then the satellite imagery, you can see whether or not the roof is intact. But then having somebody actually go out to the property gives you that last bit of confidence. Title is where you're going to find out if there is a first position mortgage. And you're also going to want to pull a credit report to make sure that the value of that first position mortgage or senior to you mortgage means that there's still equity available to your position lien. And then finally, taxes, making sure that the property taxes are current, or if they're delinquent, incorporating that into your equity so you understand how much equity truly is in that deal. Next, we've got the borrower. And this is where we're getting into credit. Now, credit is important for a number of different things. One, it'll have public records on it. So if the borrower has filed for bankruptcy, you'll see a flag on the credit report. Bad news with bankruptcy is all of the trade lines, which are all the debts on the credit report, they all stop reporting when a bankruptcy is filed. So that's where the bankruptcy, you do get a bit of uncertainty if you're just looking at credit and you don't pull up the voluntary petition in the bankruptcy docket. That being said, the credit report also gives us the borrowers just a snapshot of the borrower's lifestyle. You can see if they lease or lease or finance a vehicle. You can see if there's medical debts. You can see how their credit cards look. There are other secured liens on the property, so you can determine the equity, basically getting a better picture of that borrower's financial situation. The FICO score, of course, will let you know if that borrower might be a candidate for a refinance. So you can see if you might be paid off sooner, which really increases your internal rate of return if you're able to get a loan paid off sooner. The courts is next here, and that's going through PACER again to look at the bankruptcy courts and checking the public records to see if there are any other filings that you might be wary of, like lis pendens, which is the first part of a foreclosure. If another lien holder is pursuing a foreclosure against that property, you want to make sure that you check it out. Next, we've got assets. So we mentioned before with unsecured debt, if a borrower has other assets, you can actually pursue unsecured debt by garnishing their wages or attaching a judgment to other assets. So having other assets in general is going to just make for a more better underwriting for a borrower, because you know that they just have a little bit more resources. And especially if you're buying a lien, a note secured to their subject property, their owner occupied property, and they have rentals, they'll probably sell those rentals to make sure you get paid off before they'll sell their primary residence. And then finally, skip trace. So skip tracing means checking the borrower's current location, where they're living now, seeing all their contact information, their associates and relatives, and just getting a better picture, if you buy the loan, how you're going to do your outreach to communicate with that homeowner. And again, I'm defaulting to non-performing loan conversation, which is helping the borrower get back on track. So generally with reperforming loans, you're going to have that information as part of the package that you're purchasing, because the lender has a relationship with the homeowner if they're currently making payments. All right, last step here, the C, the counterparty, and this is so critical. And what I mentioned with dealing with platforms like PaperStack, you need to understand who you're buying the loan from, maybe even more so than the assets that you're buying, because your deal could be totally ruined if you purchase the loan, you wire the money, and then you never get your paperwork. You never get what you paid for. So that's where your counterparty can make or break a deal. And first thing is your assignments and your allonges. So in public records, whenever a loan is transferred from one lender to another lender, from a buyer to a seller to a buyer, the assignment of mortgage is recorded on title in the local county records. So seeing that assignment and making sure that it matches the contract that you're signing to purchase the loan, and that the people you're talking to are actually employees or principals of that company. So you're not dealing with a third-party broker, and the actual company you're buying the loans from is not part of the conversation. The assignment chain can show you that. And on the same page, the allonge transfers ownership of the note. An allonge is an endorsement of the promissory note. It's not recorded in public records, but it is an essential part of the collateral package. So the assignment and the allonge, they're a chain of title that transfers from the originator to the secondary market, and then to any other subsequent parties that do purchase that package. The note and the mortgage both get assigned and endorsed simultaneously. So making sure that the package is complete, reviewing the seller's collateral files to make sure that when you purchase the loan, you're going to have a clean chain of title coming into your entity is an important part of your due diligence. Borrower records is the next one here, and that is essentially checking the conversation history between the lender or the lender's servicer and the homeowner. So you're able to just see the rapport that's been built, see if there's any sort of contention between them. If it's a hostile homeowner for some reason, you'll see that in the servicing records. Complete collateral, like I kind of mentioned with regard to assignment and allonge, but you're also going to want to make sure, of course, that you have your note and your mortgage. The mortgage is not quite as important, only, hear me out here, only because it's recorded in public record. So you can go to the county and get a certified copy of that mortgage. The note, however, is critical because it needs to be the original note. And if the original note is missing, then you'll need what's called a lost note affidavit. So it's important that you have that original note or a lost note affidavit in the package, and making sure that your counterparty is evidencing and warranting the fact that they do have the complete enforceable collateral file is a really important clause in their purchase agreement. That's part of the representations and warranties that a seller will sign when they sign off on a loan sale agreement, to just give you some confidence that you're going to get what you paid for all of those files. And while we're on counterparty, I will mention the fact that you can use a third-party escrow company to close a mortgage note deal. And for your first one especially, it's especially your first time working with a new seller that you haven't done business with before, working with an escrow agent who will essentially take the collateral file, that folder of documents, and take the cash and only transact once they've confirmed that everything is in that collateral file. That's a great resource, a great use of your money to spend on a first-time transaction. And it'll also give you a bit of a crash course in what a complete collateral file looks like. Most of the time, an attorney who's works with lenders would be a great third-party escrow, or a company that does custody of loan documents like Richmond Monroe, or I bet like Iron Mountain might have an escrow service, but anybody who's a document custodian may be of assistance with the escrow side. And then finally, we have decision maker here. And again, I don't know why I like the A, B, C, D. So the decision maker is just making sure that the person that you're negotiating with has the authority to sign off on a loan sale agreement. Because the worst thing that can happen is you go through this whole process, you do all your due diligence, you spend money and time analyzing the loan, and then you realize you were talking to a third party, or you were talking to a partner who didn't have authority because they've got 3 other partners that need to sign off on a deal. So just making sure you establish very early in the sale process that you're working with a decision maker is critical. And if you guys have bought real estate before, then I'm sure you're already familiar with the fact that you need to make sure that all of the counterparties, the decision makers, can sign off on a deal like this. So that is the ABCs of due diligence. And let's get into calculating your return. So cash on cash return is just the super easy way to just make sure that you're getting a good return on your money. And it's kind of misleading with mortgage notes, which we'll discover in a minute here. But let's just go through the math first. Let's say you're making $500 per month on a note that you purchase or that you're analyzing to purchase. There's a $20 monthly servicing fee. That's pretty standard. You could see it as high as $30 or as low as $15 a month, but you're going to want to put something aside for servicing, because that is the administration on the loan. That's collecting the monthly payments, sending the monthly statements at the end of the year, sending the 1098, the tax document evidencing the interest that's been paid on that loan. You don't want to have to do all that yourself. So having a loan servicer in place, especially for a self-directed IRA, you want to make sure that you are not actively managing your assets. So having a loan servicer handling all that is critical. So that leaves us with $480 per month left over. And we annualize that, multiply it by 12 to get $5,760 per year. And if we wanted a 15% return on this, we would divide that by 0.15 to give us an investment amount of $38,400. So to recap, you spend $38,400 and you're getting back $500 every single month, well, $480 after your servicing fee, then you're earning 15% on your money. But the thing with a mortgage note is that loan gets paid off eventually. That balance gets paid down. The borrower now has a lien release. You have to record a satisfaction, and all of a sudden your cash flow is dried up. So what if the balance on that loan was only $35,000? Then all of a sudden that 15% return you're expecting is much less, and you're actually a negative return. Well, actually not in that example, because you're receiving interest with these monthly payments. It's principal plus interest. If you know anything about amortization, you know it's all front-loaded with interest. So that borrower is paying a lot more than the principal amount, but it's still a really important consideration here. And that's why we use internal rate of return. And this gives us a full picture of a investment, not just that snapshot of your 1 year cash on cash, but your full life cycle. So we're going to simplify this for the sake of this presentation. But again, $500 a month. But now we've got terms in place. It's a 20-year term, 9.9% interest. So that's on a $52,000 balance. You're going to receive over $100,000 when you take the principal plus interest payments. So this is really the full amount that you're going to get, and that's where we're going to calculate the internal rate of return based on. But when you're calculating your cash on cash, which is a great little snapshot to use at first, you want to make sure that that $38,400 is less than the balance that's being sold, because sometimes a $500 per month loan might have a balance of 20 grand. Like that borrower may have originally owed 52, but has paid it down over $30,000. And now they've got a 500 month per month payment still, but their balance is much less. You can't pay $38,000 for that loan anymore. Even though it would look like you're getting a 15% return, you're going to have to pay less than the principal amount, which would mean your cash on cash looks even higher, but your internal rate of return is going to be more reasonable and actually the accurate way to calculate your return here. So this is like a back of the envelope way I like to calculate internal rate of return. I would highly recommend using the formula in Excel, XIRR. If you just Google how to use XIRR in Excel, you'll find some great tutorials. It essentially just takes a string of outflows and inflows of cash and a string of dates and turns that into an internal rate of return. Super easy to use as long as you calculate in Excel all of your money coming in and going out. It can even do irregular streams of income. For example, if you got a payoff 5 years early, you could put that in and see how that increases your internal rate of return. But I like this back of the envelope version. You're essentially taking your ROI, so the total amount you collected minus the cost basis, so what you paid for the loan, divided by the cost basis, that's your ROI, and then dividing that by the amount of years it took to achieve the full exit. So in this case, the $115,200 was the full amount of all the payments that we received over those 20 years, minus our investment of $38,400, divided by $38,400, and then dividing all of that by 20 years. So that's a 200% ROI, but over 20 years, it is a 10% internal rate of return. So just like that, you can find that your cash on cash was overstating the actual IRR on the deal. But you can do much better if the loan was paid off earlier. So here's another example. Instead of that full 100 grand, we only made 52,170. The borrower basically just paid off the loan after half a year. So I see in the years to exit, we do 0.5 because this is paid off in 6 months. So the borrower paid the monthly payment for 6 months, and then they just paid off the loan in full. 52,170 minus your 38,000 investment divided by 38,400. That's a 35.85% ROI. But since it was just in half a year, your internal rate of return is over 70% on this deal. And if you're able to do that twice a year, then you're compounding your investment so much faster. So really important to understand that with mortgage notes that the borrower can pay off early, but generally that's better for you as an investor to get your capital back quicker. And just as a point here with loan modification agreements, we never write in a prepayment penalty because we want our interests to be aligned with the homeowner. So by having a prepayment penalty, the borrower might put off the fact that they could refi and get a better rate. And a refi, we love that because we get a full payoff and our internal rate of return is significantly higher. We can redeploy those funds and keep compounding our investment. All right, let's get into exit strategies here. How to liquidate and monetize. So first is the fix and flip. We mentioned this already. You can also fix and hold, but essentially taking a non-performing loan, modifying it with the homeowner to get them back on track with monthly payments, sometimes taking a down payment that is often like equal to what you paid for the non-performer, so you can get all your investment out of the deal right from the get-go, and then collecting those monthly payments, which are amortized, front-loaded with all that interest. Collecting those, holding them in your IRA is a great method. And one strategy here for when you're part of a community of note investors like our FIXnotes community, you can't buy loans from your own portfolio. As a self-directed IRA client, you can't self-deal like that. You can't buy your own asset. But if you have a friend who's in the business, they're turning non-performing loans into performing loans, you're doing the same outside of your IRA, you can buy in your IRA one of their loans, and they can buy in their IRA one of your loans. So you can do a fix and flip and trade assets in a way that has that arm's length, essentially giving you the ability to add assets to your IRA in the business that you're already working on the side with the non-performing loans. Next, we have lump sum payoffs and structured settlements. So a lump sum payoff is pretty simple, often can be a discounted settlement. We buy these loans when they're non-performing at pennies on the dollar. I say pennies on the dollar because I've been in the business since 2011 when it truly was pennies. Now, a lot of times you're seeing loans for 50 cents on the dollar, sometimes more, sometimes less, but generally around 50% is what you're spending on a non-performing loan as a factor of the unpaid principal balance. So a $100,000 loan, you might buy for $50,000 and negotiate a deal with the borrower to pay it off for $80,000. Or a structured settlement, you might say 4 payments at 20 grand over the next 4 months. Or a loan modification, as we mentioned in the first line, where you are amortizing it with interest. And then finally, a deed in lieu is the DIL, or an actual foreclosure to acquire the REO. So if the homeowner is not interested in keeping the property, as the lender, we have the ability to take back the deed. A deed in lieu is a cooperative way to work with the homeowner to get the deed. And then a foreclosure, of course, is when you go through the court system to take back the property that way. So we've got all the leverage as the lender. All the cards are stacked in our favor when we own the debt, We don't have to deal with the tenants, the toilets, the termites, all of that stuff. All we do is collect that monthly mortgage payment from the homeowner or the landlord. And that's probably their number one priority before they're fixing. I actually got a text last night from my property manager. Water heater blew up. Not blew up, but the water heater's dead. We got to get it fixed. But if I only had, $2,000 left in my account and it's either the water heater or the mortgage payment, you got to pay the mortgage payment. And that's the power of being on the other side of these deals as the lender. So that's it for the presentation here. I'd be happy to go into some case studies or answer some questions. But as you can tell, I'm totally fired up about mortgage notes and happy to be here sharing it with you. Let me look through the chat here. A copy of the recording. I think Will might have that. It did look like it was being recorded. I see that.
Yep.
Nice.
Cool.
Cool.
Every registrant will receive a copy of the recording. I let Bill know that. A lot of great information so far, Robert. It does look like there was a question that came into the Q&A. Were you able to see that? I can read that out to you if
Yeah,
you'd
no,
like.
I did touch on that when we were in the sourcing section about kind of the overall macro environment with regards to mortgage notes. And just to reiterate that, you are somewhat protected as a note investor because of the substantial amount of equity in the average home these days until that equity really gets breached, where we're seeing above 100% combined loan to values. That doesn't affect pricing too much because we've got enough equity buffer at this point. But as home values come down, it is possible that the market will flip and we'll see lower asset values on the note side of the business as property values come down. The other factor I mentioned there was refinances being a little fewer and farther between because of the fact that interest rates are higher than most people have on their current home loans. So that means that early payoffs aren't as common, but you'd be surprised. I'm surprised every day about the loans in the portfolios that I manage still are getting refied. And I think that's generally a function of the fact that we write our loan mods at 9.9% interest. That's why I use that in the example, so that we're slightly higher than the institutional, the competitive rate they could get if they refi. So there is that alignment of interest where the homeowner can get a better rate if they refi. So we always make sure to write our loan mods higher than the market. Can you roll another one from Brad here? Can you roll a 1031 proceeds into this type of investment? That's a great question. I don't actually know. I would imagine that you can, probably not in your self-directed IRA, but there might be a way to work that deal out. I know most of the time 1031s are for like exchange, an asset that's similar, but I have heard there are some methods. You'll have to talk to an attorney. Yeah, happy to answer some more questions, guys. If you got anything else, throw them in either the chat or the Q&A box.
Yeah. I think there was also a question Jim asked about your school that you run.
Oh yeah, for sure. Oh yeah, I see it here. So FIXnotes started with the mission to democratize the secondary mortgage market. So my whole mission is just to provide information to help mom and pop investors crack into this Wall Street investment. Because as I mentioned, with the fact that this is such a powerful strategy, it's sort of a Wall Street institutional strategy, and everything has been designed to keep it that way. So I think there needs to be more people who are sharing the opportunity here. So you can check out our YouTube channel. If you just search FIXnotes, FIXnotes. We have a ton of YouTube content. Last Wednesday of every month, I do a live program on YouTube, and then got a ton of short videos as well. A huge back catalog there. And then we've got our training, our course on our website and our community there. There's some options. If you go to fixnotes.com, you can see how we work with our clients. But essentially, that's the mission: democratize the market and get notes into the hands of more investors. Because at the end of the day, that's the location freedom that you can achieve by not being tied to the sticks and bricks. Yeah, thank you for your time, everybody, for being part of this call. Here's another question from Jose here. As the lender, and if you wanted to help the homeowner refi, what are the terms do you look for? Yeah, so good question there. That is a strategy that I don't get into too much. I'm not a RMLO, but if you work with a registered mortgage loan originator, you could essentially give them the deals in your portfolio to work on refinances for. So I would say just making sure that the interest rate is lower than what your modification is at. That would be the first qualifier. And you can identify the borrowers that would be more likely to refi just based on their FICO score. So if you do have a portfolio of loans, you can go through and see who could be candidates for a refi. find a registered, a licensed mortgage originator in that market and feed them those leads, because it's a win-win. You get paid off when the loan is originated, the homeowner gets a lower interest rate, and it's an awesome synergy there between real estate professionals. The most profitable exit strategy for performing loans is going to be, and based on internal rate of return, it's when the loan is paid off early. And just looking at the example here, that 20-year term, if we paid it off all 20 years, we only had a 10% internal rate of return. But because that loan in my example paid off the first year for $50,000 less, but it took 19 and a half years quicker, that return was so much higher because of the time value of money. So that'd be the most profitable strategy for performers for sure. Actually, I would say another profitable strategy for performers is if the borrower refis with you. Like, for example, I had a deal the other day where it was an interest-only loan modification. So they're just paying their monthly interest payments every month because they couldn't afford a fully amortized loan mod. At the end of the 3-year term, then we get them into a regular amortizing loan mod. And again, they're at the beginning of the amortization schedule. And if that deal 5 or 10 years later, the borrower's like, hey, I really can't afford this monthly payment, it's too high. And also I can't get qualified for a refi with anybody else. Would you rewrite my loan mod? Well, you might be accepting a lower monthly payment, but because you're writing a new loan mod and they're beginning of the amortization schedule again, you're getting all that interest front loaded all over again. So long-term, another profitable strategy would be to keep rolling over with new loan mods. But in general, if you're looking at internal rate of return, an early payoff is your best bet. Couple more here. This one came in first. What is the best way to connect with investors in the space? How to network? Our community is amazing. I've been building it since 2011 when I started in the business, but didn't formalize it until I started our mastermind in 2020. And that's really where I cashed in all the goodwill over the years and years doing business with the investors in my network to bring them more formally into our mastermind group, where we meet weekly. We have an open office hour first every Monday at 4 p.m. Eastern. And then we do a monthly call on the first Wednesday of the month. So last Wednesday of the month, I'm on YouTube for the public. And first Wednesday of the month, we do an expert session exclusively to our group. And we also have a forum on the FIXnotes site. So daily we communicate, just in a forum, kind of like Bigger Pockets, but we're exclusively talking about debt, mortgage notes, performing and non-performing. So online, I think that's the best way. In person though, conferences, events, there's a lot of specific events for note investors. I would say in the beginning of your journey, I would recommend the Diversified Mortgage Expo, the DME in Nashville, that's run by Nathan Turner. And as you get more experience going to the IMN events or the MBA, IMN is Information Management Network and MBA is Mortgage Bankers Association. Those conferences are a little bit better when you want to connect with bankers and institutional lenders. Next one here about, can you speak a little more about the interest rates you typically align with? I know you mentioned that you want to make it attractive for the customer to refi, I guess like with fix and flips. Show us a few more case studies and repeat your YouTube channel. Yeah, YouTube channel, I'm going to type this in. It's just FIXnotes. If you just search that on YouTube, you'll find us, FIXnotes. And as far as the case studies, yeah, if we've got time, I can pull up a few of those, but I do have some more questions. Sharon asked, is the forum free to join? It's so funny. It was free yesterday, and then my team convinced me to put it behind a paywall. So as of yesterday, it's a one-time fee to get access to our course, our community, and we're going to be doing weekly workshops, actually probably monthly workshops. So we're adding a paywall, but we're also adding a bunch more just resources. That's a new change. So email me and I'll probably be able to get you in at a discount because it's brand new. Is my company a custodian for self-directed IRAs? No, I'm not a custodian. You got to work with Camaplan. I'm a Camaplan client, actually. I've been a client of Camaplan since like 2012, and this is my first time doing a webinar with them. Do you JV on notes or have a fund? No and no. I really don't like having investors personally. I think that defeats the purpose of creating a lifestyle business. And I was at a DIG meeting last night, and it was great. The presenter, he wasn't a notes guy. He was wholesaling and also doing like fix and flips and rentals. And he had the same philosophy, and I loved it. He was just saying how he maybe was he called himself a control freak, which maybe I am too. But the idea of having full control over your investments and not having partners to deal with or investors just gives you way more freedom. So I believe that the advantages of being a lifestyle business outweigh the disadvantages. So if you scale up and have a note fund, you can have like way better wholesale deals. You can work with bigger sellers. But the way I've kind of overcame that as a lifestyle investor is putting together this group of professional note investors. So if we have this critical mass of investors that we work with, then we can do those big deals without having to have investors. And instead of like a JV, we can do, I forget the word, it's more like just a strategic alliance where we essentially pull our capital together, not into a shared bank account, but just into an offer, and then work with a seller that's willing to assign these loans to different counterparties. So they can wire all the funds separately, but the seller can collect them all together and split up the portfolio. So it's the same objective. They sell all the assets, but a bunch of investors can participate. Let's see what else we got here. From Jose, other than that, since you can't control that, I guess I missed the, the first part of that, Jose, sorry. What states do we buy in? So part of our professional network, the resource that we provide to our members is a state-by-state database. And you can just Google this, but we have it organized in a way that's really useful for note investors in our portal. But essentially, it's best when you buy assets in non-judicial states. So every state is either judicial, non-judicial, or a hybrid of both. And that essentially means in a judicial state that it goes through the court, in a non-judicial state that a foreclosure can just be filed and you don't have to go in front of a judge. The states that are a mix of both, it's non-judicial until the borrower challenges it, and then it will go in front of a judge. So generally in non-judicial states, the process is a lot quicker if you should have to foreclose, and they're generally more lender friendly. Now, not to say that I don't invest in judicial states as well. I'm in Pennsylvania, neighbors with New York and New Jersey, all judicial states that take a very long time to foreclose. But sometimes the advantages of having local real estate knowledge, being in the area, being able to drive to the subject properties, that can outweigh the disadvantages of being in a judicial state. And by the way, when you're buying a cash flowing loan, the odds of that borrower defaulting, especially if they've got equity in the deal, are pretty slim. So even if you're buying judicial versus non-judicial, it's not as big of a consideration with cash flowing. And that is the advantage of notes. You can buy nationwide because you don't have to have that presence in that market for the most part. And there's nationwide companies that do property preservation and rehabs if you need to, and all sorts of other resources in the industry where you can operate your real estate business remotely. It just makes it a lot easier when it's paper and not the actual physical collateral or physical property. Cool. So happy to answer some more questions here, but if we don't, let me see if I can pull up a case study or two. I had another document here. All right, so I've got a couple of different options here. I'll kind of skim through and see if anybody has any particular one that jumps out. So these are a bunch of case studies I did the end of last year. So I've got a non-performing junior that was modified, a non-performing senior that was paid off, a loan sale, payoff, a sale, a payoff, a modification. Here's a reperforming loan. Let's do this one just because we're talking about cash flow loans in the first place. Jose asked, what is the average discount one could get for cash flowing notes? So if you're buying a cash flowing note, it's generally going to be priced based on the internal rate of return and the cash on cash return. So the discount to the principal balance is sometimes more of an afterthought than what is the cash flow that you're achieving. And in general, for first liens, 8 to 14%, and for second liens, maybe 12 to 18%. So that's the cash on cash return, but then buffered by the internal rate of return. All right, let me actually just play this one. I don't know if we have time for this, Will. Do we have time for, is this ending in 3 minutes?
Yeah. Is there any way we can get this? Maybe we can email it out to the registrants afterwards. I don't want just
Well, you know
because
what? This one, these case studies are recorded on my YouTube channel, and I do a case study on every one of my live episodes that are like 20 minutes to an hour long. Those ones are like 5 to 10 minutes, super actionable. If you go to the FIXnotes YouTube channel, that exact one is already on the channel. So you can watch that presentation at your leisure over on the FIXnotes YouTube page.
Perfect. I'm sorry to cut you short. I know there's a lot of good information you have. Maybe we need to have you back on for another webinar soon.
That would be awesome. Can I do one more question here from
Absolutely.
Catherine? Thanks.
Absolutely.
Catherine asks, how much do notes normally cost? So I have a perfect answer for this because I have a spreadsheet of all the deals we've closed in the last 18 months or so. Now, caveat here is these are NPLs, these are non-performing loans. But what you'll see on this spreadsheet is all of the contract prices of the assets that we've sold. And you'll see here that the cheapest loan we sold this May, $400. And this one was kind of an outlier at 2.5 cents on the dollar. Because there's other factors, the property wasn't in great condition, there wasn't a ton of equity, but I was a one non-performing second lien for $400. You can see here there's a dozen or so, all sub $10,000 with a range of percentage of UPB discounts from, that outlier, but more like 25 to 68%. And the factor that determines what the percentage of the UPB is over here. It's generally the senior status for a second and the equity status. So a current senior, a second lien behind a current senior with full equity, that's where we're seeing like almost 60 cents on the dollar. And if we go down to the low end here, if we're looking at negative equity, foreclosure initiated, like in rough shape, then we're talking more like 30 cents on the dollar. And there's some outliers here as well, like this particular loan is a single asset. If we had a bigger data set for semi-current seniors, this would actually be a little bit higher. But for whatever reason, this probably had substantially negative equity. Also, we've broken it down by state as well. And I'll type into chat where you can see this spreadsheet because it's just like a nice look at what loans are trading for on the non-performing side of the business. And by the way, the small balances you see here, the small amounts, are because we allow cherry picking in our group. It's pretty tough to crack into this market if you don't work with a seller who will piece out a portfolio like this. There's often minimum trade sizes. You're not able to really get started until you have at least 100 grand, or some sellers even $1 million is the minimum trade size. So we sell loans as low as a $400 contract because, again, our mission is to democratize the market. And to democratize the market, we need to work with investors who are getting on their feet and want to just learn the business through these smaller balance loans. And it actually is a win-win because the bigger investors, they don't really want the smaller balance stuff because it's way more work for them for smaller dollars. So they leave those assets to the beginners, learn the business, and eventually scale up to the higher value loans. And I'll type that into the chat here, fixnotes.com/metrics. You can see that spreadsheet.
Perfect.
And pop that in. All right. Sorry to go over by a minute there, Will.
No problem at all. Thanks so much. A wealth of information you provided us today. I really appreciate you lending your time. Do you want to leave off one more time with how people can reach you if they're watching the recording or they want to reach you offline?
Yeah, I think FIXnotes.com is the best place to go. We've got a bunch of blog posts that have a bunch of resources. The first like 4 lessons of the course are all not behind a paywall. So FIXnotes.com/learn. Oops. Oh man, that's bad.
It's
/learn.
okay.
You can go read the first bunch of lessons. And I'm actually working on a video to correspond with all those lessons. All of our like advanced training is done with screen shares and videos like this. But our free course doesn't have video yet. So I want to get that put in place pretty soon. So definitely get on FIXnotes.com, get into our world, and you'll be on our email list and stuff so that we can send you developments as new assets come out, as new training is available. And I'd love to work with each and every one of you. And I think that being at a self-directed IRA webinar, you guys are already my people. You know where it's at. You know how to maximize your financials. And so this is awesome hanging out with you guys on a Thursday afternoon.
Perfect. Thanks so much again, Robert. A lot of good information. We're going to need to have you back out again sometime soon. I want to thank everybody who came and attended live, asked some great questions, and anybody who's watching this recording in the future, I really appreciate it as well. One more thanks to you all, and I hope you all have a great rest of your day.
Thanks, everybody. And Jim, hit me up after this. I know Jim's got his hand raised, so be happy to give you, some attention over email. I'll put my email in as well, rob@fixnotes.com. So please
Perfect.
shoot me a message. Happy to help you all. And nice to see you, Sharon. I knew a couple of people in the chat here, so awesome.
All right.
Appreciate it.
Thank you. Take care, everyone.